Hey guys, hope you are all having a great morning. Today we wrap up this little crypto market manipulation series. I think what we are going to do today is discuss the influence that all these 7 methods of manipulation have in more detail, while also provide some awareness of the real scope of how much bigger this manipulation of cryptocurrency markets is. Yesterday, we talked about market vulnerabilities and how the government is approaching the situation in regards to the SEC trying to impose regulations. Today, we are going to talk about decentralization of exchanges, which would be the nature course of action for people making these exchanges if they don't want to be regulated. We are also going to talk about the Indian ban on cryptocurrency and truly see if it is actually possible to completely do it, or if it's a fool's gambit. Before we start, let me quickly state that I am not a financial advisor, and that all content discussed in this channel is simply information gathered that I deem important for people to know, so that they can make informed decisions. All efforts are aimed to better understand the nature of the current market in anticipation of the greatest squeeze in financial history. Let's get started. You have probably heard about the biggest crypto exchanges out there, like Coinbase or Binance. With millions of dollars spent on advertisement each year, they have drawn millions of customers in. As you might imagine, the trading volume on each of these exchanges is huge. But what if I told you that there are days when the crypto trading volume through decentralized exchanges outstrips the volume on major centralized exchanges? As Peter Van Valkenburg put it last 2 years ago, regulators have come to expect that any exchange from one cryptocurrency to another will, by necessity, occur through trusted third parties, and while this is unlikely to change with regard to exchanges between sovereign currencies and cryptocurrencies, it will soon no longer be the case for exchanges between cryptocurrencies and any other asset that are similarly blockchained. In essence, what Peter so brightly concluded was that changes made by regulators are not going to pass through to third parties. Regulation of centralized exchanges will not have the broader effects the government thinks it will have. There are 3 things you should know about the intersection of decentralized exchanges in regulations. We have financial surveillance, securities regulation, and constitutional law. The first 2, surveillance and securities, are not necessarily structured to apply to people developing, implementing, hosting, or using a decentralized exchange system. The third one, constitutional law, actually serves as protection to people from the law itself in certain applicable circumstances. We are going to break each of these down, so that you can truly get a grasp of what should be fair in terms of regulation crypto markets and what isn't. Since the 1970s, the Bank Secrecy Act has obligated financial institutions serving Americans to collect and report information about their customers' financial transactions. This is sort of where the Know Your Customer checks come from, which we discussed in a previous video. Financial institutions are forced, by federal law, to provide information to the Treasury Department about their customers, from identify to transactions. As crypto markets continue to grow and expand into financial services, such as providing credit cards and debit cards, and in the near future, even loans, many of these exchanges will be expected to be subject to the BSA laws and requirements. When it comes to this issue of surveillance, I think only custodial wallets and exchanges, like Coinbase or Binance, should be required to comply with the BSA. I think all third-party custodians should follow uniform regulation because they are holding other people, their customers, money and wallets. On top of that, they want to integrate themselves as banks, and as such, customers using their services should be treated to the same securities that the government enforces. This would actually decrease some of the manipulative methods we talked about, like insider trading and even losses by DDoS attacks. However, crypto exchanges that are decentralized, and even other entities that are not third-party custodian, should not be subject to regulation. This comes for individual investors, software developers, miners, nodes, and multi-sig providers. If software facilitating decentralized exchanges is designed to never give anyone third-party custody over crypto, or have people settling trades peer-to-peer, then developers of such software should not be regulated. That way customers have the best of both worlds to choose from. Those that want certain securities and benefits can choose decentralized, and those looking for unrestricted and unregulated trades can opt for decentralized. And this is where we get to the second category, which was securities regulation. The aim for securities regulation is to protect investors from fraud and misrepresentation of value or information. Securities laws apply when the asset being traded as a security. However, when it comes to crypto, coins that do not have an issuer upon whom token holders rely on for the expectation of future profits simply do not meet the criteria of a security, and those that have an issuer upon whom holders can rely for an expectation do meet the criteria for securities. As such, that would mean cryptos like Bitcoin are not securities because there is not central issuer managing a network or promoting it. This should be the way to approach this touchy subject regarding the regulation of securities. Simply put, the future promise of new cryptos and their categorization into its perceived allotment in the confines of regulatory booking should be defined by whether they have an issuer whose holders rely for the expectation of future profits. If it does, you could then apply some regulation. If not, there is nothing the government can do. Lastly, the last category we fall back to is the constitutionality of the regulations itself. Yes, even regulators should and have to obey the regulations predefined by our forefathers in the American Constitution. If a person who develops or implements the tools needed to decentralize an exchange was ever charged by the federal government for violating security laws or financial laws, they would actually have a pretty good amount of defense granted to them by constitutional law. The two primary defenses that they would have fall on the First Amendment and the Fourth Amendment. The First Amendment grants us freedom of speech while the second one grants us a right against warrantless search and seizure. So let's break this down hypothetically. If a person is developing a decentralized exchange or releasing such versions into the general public, and is also not nefariously advocating the illegal use of that software, collection feeds from people using such software, which would then make the exchange fall under regulatory oversight by the BSA as previously stated, and if the person does not maintain a website by which people access and use the software, this gives the person a strong case that the software publishing activity alone is a constitutionally protected freedom of expression. Now, this wouldn't mean the government cannot regulate this type of activity, but that any regulation itself shortening or curtailing free expression will itself face strict scrutiny from the courts and would most likely falter if challenged. The amount of scrutiny from the courts and the Constitution would forbid any state or even federal government from banning publication of a decentralized crypto exchange. For example, say that developers would suddenly be forced to impose a know your customer type of token in their decentralized exchange. The type of regulation that the BSA forces financial institutions to implement is previously stated, it would be easily challenged as unconstitutional intrusion of the right to speech. Already that would be a steep hill battle for regulators trying to pass this type of regulation, but the First Amendment wouldn't even be the only one working against them. If a developer was told that he has to include surveillance tools in decentralized exchange software, that mandate would easily be challenged as unconstitutional warrantless search. Let me explain. The BSA mandates massive warrantless data collection from centralized exchanges, and the one and sole reason why they were allowed to do so was because the subjects of the search willingly provide their information to the third party. To sign up for a bank account, you give up the right to be searched voluntarily at the hands of the third party, who retains all your information for legitimate business purposes. When there isn't a reasonable expectation of privacy, the government cannot get a warrant to search or seize any of your information. These 3 points are the pivotal points where regulation meets crypto exchange policy. Policymakers would do well to inform themselves as to this because any regulation they make that isn't backed by the Constitution will undo any of the work they are trying to do to protect consumers. In the topic of legality, we have seen many other countries overregulate crypto or even outright ban them. India comes to mind right now, after reports came out saying they plan to ban crypto completely. However, new reports have come out showing that official sources are now changing their stance into that where the government may allow trading and investing in these assets with certain restrictions. The reason why they are backing away from the outright ban is obvious. You cannot expect to completely ban cryptocurrency, because it is impossible so long as people have a computer and internet. If India was to make it impossible, they would have to disable all internet and take away all computers, sending themselves back to the dark ages. What the government is being forced to do is restrict certain trading in crypto so that the means of exchange and payment are affected. Cryptocurrency exists on a blockchain that has no single entity controlling it, which is what makes them powerless to stop it. This decentralized nature separates them from other digital currencies that would otherwise be under control by a single entity. What India could possibly do is ban exchanges from operating in their country and monitoring financial institutions like banks to make sure people are not withdrawing or depositing money from or to a crypto exchange, but a full ban on crypto is impossible because they are driven by communities of developers and crypto enthusiasts. This should be seen as a cautionary tale for other countries, including the United States, into how to handle the situation. It is clear many public officials are upset because they feel threatened by the rise of cryptocurrency while currencies like the dollar keep on sliding and slipping. They have to manage this very carefully if they want to protect people, because crypto is here to stay forever. And this is the end of the series. I can't believe we got those 5 episodes, but man am I super happy I got this out. I have been getting crypto series requests for months on end, and I am finally happy to deliver it. This was exhaustingly difficult to research and slow to put together and publish, but if you guys grew a wrinkle out of it, then all that effort and work will have paid off. Let me know if you liked the series, if you watched all 5 videos, if you want more crypto-related stuff in the future, and if you are liking the general flow of this channel. Tell me everything that is on your mind. If you want to support this channel, I have a Patreon link in the description as well as some one-time donation links for Cash App and PayPal. Thank you again for being a part of this channel. I will continue striving for better content. Hope you keep having a great day, and I hope to see you later today on the recap video. Until then, keep on buying the dip and to the moon.